to be here, and thanks very much, Mike. My normal meeting with Mike is we sit down, we have a cup of coffee, he speaks to me, gives me my assignments for 12 minutes, and then I move on, actually.
As long as you do them, that's fine.
It's highly efficient, it works just fine, and then we smile, we move on, and we work on it. But I think I'll come back to the question of the pull system, because I do think something fundamentally has happened. But let me explain why it happened, and then how the change occurs. Because to business schools, business students, you might say, well, how could a collective group of intelligent people have wound up into that system? And I think I perhaps can give you a little bit of insight as to how it happened historically, and then what has changed to change that model going forward. So I'm going to talk more about the future, from crisis to opportunity, but hopefully I'll give you a few insights as to what led to the crisis, and then what's been done about it. I have worked for General Motors for 25 years. I've run our businesses in Brazil, Mercosul, South America, Latin America, Africa, Middle East, Asia, Europe, and came back to the U.S. in January of 2006 as CFO of the company. It's been a wild ride. I became COO in March of 2008, so in that, I call it the descent to hell, actually, in 2008 and 2009, actually. I got my job April 1st, 2009. It was a very difficult weekend and a very difficult period, but things had to get done. And so from April 1st until June 1st, we spent a lot of time basically fixing broken pipes, dealing with major strategic issues which have been with us for decades. It had to get done, it had to get fixed, either planning to do it or just fixing it. And then, on June 1st, as the CEO of the company, I went forth at 60 days after I got my job and recommended to the GM Board of Directors that we file General Motors for bankruptcy. Toughest day of my professional career. But it had to get done. And I'm going to tell you a bit why, but it had to get done because we had to fundamentally fix some parts of the business so that we could create a future for the company. We had a 40-day trip through bankruptcy. I just shortened it for my presentation. Made it through bankruptcy, and you say, okay, now where do you go? From the company perspective, it's a very different company. A new board of directors is very important in terms of governing the company. Ed Whitaker is our new chairman. 7 of our 13 directors changed out on July 10. We run the company differently. We've removed layers of the company out in basically between year-end 2008 and year-end 2009. About a third of our executive team has been removed from the company. We didn't have bad people. We had too many. We didn't have bad plants. We had too many. You had to deal with the problems, and you had to deal with it honestly, transparently, very painful, but had to get done. And it's about running the company very differently every single day in terms of accelerating decisions and changing how we historically ran our business. Dealers, brands, nameplates. This is where we were for rooftops for General Motors at the end of 2008. When you think about capacity in our industry, most people think about capacity in assembly plants, and they think about capacity in stamping plants and powertrain plants. I think about capacity broadly defined, from suppliers through to our operations into our retail channel. And the fact is we had far too much capacity in all elements of our business, including our retail channel. This shows you where we're going in terms of, we would expect by year-end 2010, when we're done winding down brands, to have somewhere between 3,600 and 3,800 rooftops in the U.S. We will still have the most extensive dealer body in the U.S. We will still have the most extensive dealer body in rural and small towns in the U.S. But nonetheless, 6,400 to 3,600 is a massive change. And it's really about providing the right size distribution channel, providing retailers an opportunity to make a return on their investment, reinvest in their franchise, and grow with us in the future. Brands. Dealing with 8 brands when the market was 17 million units was tough. Dealing with 8 brands when the market is 10 million units is lunacy. Couldn't be done. You had to somehow pick and choose which brands you're going to be able to build and grow with going forward. We go from 8 brands to 4 brands, and in terms of nameplates, what's a nameplate? A nameplate is a Camaro or a Malibu. It's about going from 48, and 2 years ago that number was 70, to 34. What does that mean? That means you can focus on, I can guarantee you, we are a better company focusing on 4 core brands and 34 nameplates and getting those right than we were as a broader company with more entries. We are a better company, much more competitive, much better chance to be successful. Why? Because we can make sure we get everyone right. Structural cost. This is the fixed cost part of the business. So you say, okay, why was there a push system? If you think about it, it's a little like the treadmill. How do you get off the treadmill? And the answer is we had structural cost or fixed cost of over $40 billion in 2005. You had to try to generate revenue to cover the cost. It's very simple. And the slowdown, particularly in our business where we have negative working capital cycles, can be very painful. We had over $40 billion of structural cost in 2005. We'll be less than $24 billion in 2010, and our break-even point goes from about 16 to 17 million units to about 10 to 10.5 million unit industry and an 18.5% share. What does that mean? That means we're actually structuring the business so that in a abysmal depression-like industry, we can break even on an EBIT basis. And we don't get pushed into doing things that don't make sense for us long term. And it gives us enormous operating leverage on the upside when the business turns up. And it doesn't even have to turn back up to 15 or 16 million units, as Mike said. We just need a modest improvement to begin creating the results that we need in the business. Debt. The day we declared bankruptcy, our negative net worth on our books was about negative $90 billion. Liabilities greater than assets. So you say, how did that happen? One interesting statistic, from 1993 to 2007, 15 years, General Motors spent $103 billion on post-retirement health care and funding pensions in the U.S. About $7 billion a year. That's how much we spent annually on a global basis for product development and products. So for every dollar we're investing in our business, we're investing in our Social Security system. And the customer doesn't pay a dime for that. And over time, that, combined with a number of other things, wrecked our balance sheet. We didn't have the staying power to deal with the market as we saw it, which is what, in the end, that and running out of liquidity drove us into bankruptcy. And if you look at how the debt has been restructured, obligations reduced more than $40 billion. This is the remaining obligations of the company. This is a company with over $100 billion of revenue, substantially delevered. We've defeased our obligations for post-retirement health care. We have done a lot, actually a substantial amount, to basically fix the balance sheet so that the pressures to keep running so that you can meet your obligations, the obligations are now properly structured, properly sized, and properly termed. This is a global industry. And Mike showed a chart, 64 million units of production, of which the U.S. was 16, North America was 16, about a quarter in North America. That means 75% of the industry is outside of North America. It's a it's a growing market. A country like China, last month, the seasonally adjusted annual rate, that 10 million units you saw, was 16 million units in China. It'll be over 11 million units this year. It is growing. We have growth opportunities in Brazil, growth opportunities around the world. If we look at what our opportunities are, we have very good businesses around the globe, but they provide low-cost manufacturing. We develop product in multiple countries. I've had the great benefit of working in all these operations over my career. Talented people, source of new technology, source of diversity. It is an interesting global business, and we run the business globally. We can't win unless we win here. We know that, but the opportunity in terms of winning is immense when you look at the global scale of our industry. Who are our owners? These are our owners, the U.S. and the Canadian government. The VIBA, if you will, if you think about our obligations for post-retirement health care, they're about 475,000 retirees and surviving spouses are going to depend on the success of GM and the value of that stock for their future retirement benefits. Very important responsibility to the taxpayers and to those retirees. And then the old General Motors, the creditors of the old General Motors, also have a stake in our success. So this is the shareholder group. We're the world's most public-private company today. And all of our shareholders want this company to go public because in the end, they want to be able to diversify. They want to be able to realize from their investment, which is, I'll talk about it during the Q&A, but opportunities to go public as we look into the second half.